Silver just did something that changes the entire structure of the market. It didn't just rally, it didn't just bounce. It broke through $92 per ounce. And in doing so, it took out one of the most important highs on the chart, a level that had acted as resistance, a level that had rejected price before, a level that defined the ceiling of the recent range. And it didn't break quietly, it broke violently. The catalyst came early in the morning, new inflation data hit the tape, producer price index came in hotter than expected. 2.9% versus 2.6% forecast. Core PPI came in at 3.6% versus 3.0% expected. That difference may sound small, but in financial markets, small differences trigger massive reactions. Because inflation data doesn't just affect prices, it affects interest rates. It affects currency strength. It affects the entire financial system. And when inflation comes in hotter than expected, markets immediately begin pricing in a different future, one where currency purchasing power erodes faster, one where hard assets become more valuable, one where tangible commodities outperform financial promises. And the reaction was instant. Gold went vertical. Silver followed. No hesitation, no slow grind, just acceleration. Silver surged straight into $92, taking out the February 4th high that had capped price for weeks. This was not random volatility. This was a structural level being broken. Because markets remember where liquidity exists. They remember where orders sit. They remember where traders were previously trapped. And when those levels are taken out, the entire balance shifts. But here's the critical detail most people miss. Breaking a level is only the first step. What matters is what happens next. Because markets often break above resistance briefly, only to fall back below. These are called liquidity grabs. Moments where price moves just far enough to trigger orders before reversing. That's why confirmation matters. What traders need to see now are strong hourly and daily closes above that prior high. Not just wicks, not just momentary spikes, actual bodies closing above resistance, because sustained closes confirm strength. Wicks alone confirm uncertainty. And right now, the next objective level sits just above $94. That's the next structural target if momentum continues. And based on everything happening beneath the surface, momentum is no longer just technical, it's structural. Because while Western paper silver was trading at $92, something even more important was happening in the physical market. Shanghai, the world's largest physical precious metals trading hub, was not trading at 92. It was trading at $104 per ounce, 104. At the same moment, Western spot sat at 92. That is a $12 premium, and it gets even more extreme. Shanghai futures contracts were trading at $107. That means physical buyers in the East were willing to pay $15 more than paper traders in the West, $15. This is not a normal arbitrage difference. This is not a routine fluctuation. Normally, price differences between exchanges stay within $2 to $5. But $12, $15, that is structural separation. That is two different markets pricing the same metal differently. One pricing financial contracts, the other pricing physical reality. And here's what makes it even more important. The gap is not shrinking during the rally, it is expanding. Normally, when price rises, arbitrage closes the gap. But here, as silver rises, the premium is growing. That tells you physical demand is accelerating faster than paper pricing. It tells you buyers are competing for real metal, not contracts, not exposure, metal. Because when a manufacturer needs silver to build solar panels, they cannot deliver a futures contract into a factory. When an electronics company needs silver for circuit boards, they cannot melt down a derivative. They need physical ounces, and they are willing to pay whatever price is required to secure them. That is what Shanghai is showing, a market clearing at higher levels, while Western exchanges still lag behind. This is what structural dislocation looks like. Now layer in something even more revealing. During a 90-minute trading halt earlier this week, something unusual happened. While retail traders were locked out, institutional traders were still active. And during that short window, 159 million ounces of silver contracts changed hands. 159 million ounces. That is nearly twice the amount of physical silver currently registered inside COMEX vaults. And here's the detail that matters most. More than half of those contracts were not rolled forward into future months. They were closed, cashed out. Participants exited completely. They did not move from March to May. They did not reposition. They left. That tells you something powerful. Because when traders believe the system is stable, they roll forward. They stay engaged. They maintain exposure. But when traders begin exiting entirely, it signals declining confidence. Not in price direction, but in structure itself. They are choosing certainty over exposure, cash over contracts, control over dependence. It's the equivalent of players leaving the casino instead of switching tables. And when participants leave, liquidity decreases, And when liquidity decreases, price movements become more violent because fewer participants are available to absorb pressure. This is how volatility accelerates. This is how structural shifts begin. And while all of this was happening on exchanges, physical silver was quietly leaving vaults. Shanghai vaults saw an 11.5% drain in a single day, nearly 40,000 kilograms removed in one day. COMEX vaults also experienced withdrawals, more than 1.3 million ounces removed during the same period from multiple custodians. Not one, multiple. Brinks, HSBC, JP Morgan, MTB, silver leaving storage, moving somewhere else. Because when physical demand rises, metal moves toward the highest bidder. It leaves passive storage and enters active ownership. And when vault inventories decline, delivery pressure increases because fewer ounces remain available to satisfy contracts. This is how supply tightens, gradually, then suddenly. And perhaps the most telling signal of all is happening far from Western exchanges. In Singapore, people are lining up around the block outside bullion dealers, standing in the rain, waiting, not to sell, to buy. Because corrections do not scare physical buyers, they attract them. Lower prices are viewed as opportunities, not warnings. And when buyers consistently absorb supply during corrections, it creates a floor beneath price, a foundation built on ownership, not speculation. So step back and look at the full picture. Silver breaking $92, Eastern physical markets paying over $100, a $12 premium expanding during a rally, hundreds of millions of ounces exiting contracts, vault inventories declining, physical demand accelerating globally. This is not a normal market environment. This is a structural shift in progress. But the most important changes are still ahead, because India is about to change how precious metals are priced. Retail investors have barely entered the market yet, and geopolitical tensions are injecting massive capital into safe haven assets. In part 2, we'll break down India's historic decoupling from Western pricing. The 10 consecutive green monthly closes rewriting silver history, the geopolitical escalation adding hundreds of billions into metals, and the critical risks that could still disrupt the move. Because what's happening right now is bigger than a rally. It's a shift in how silver is valued worldwide. If you think the move to $92 was the biggest story, it wasn't. Because while price was breaking resistance, entire countries were quietly changing how silver and gold are valued. And one of the most important changes is happening in India. In just 33 days, India will implement a regulation that forces mutual funds to value their precious metals holdings using domestic exchange prices instead of Western benchmarks like London. That may sound technical, but its implications are enormous. Because India is not a small participant in the metals market. It is one of the largest consumers of gold and silver on Earth. And when a nation of that scale stops referencing Western price discovery, it shifts power, it shifts influence, it shifts gravity. Price discovery begins moving toward where physical demand actually exists, toward where metal is actually consumed, toward where buyers actually take delivery. And alongside that regulatory shift, India has unlocked something else, up to $385 billion of equity capital, now approved for allocation into precious metals. $385 billion. That capital doesn't need to flow all at once to change the market. Even small percentages would reshape supply-demand balance. Because silver is a relatively small market compared to equities. It doesn't take trillions to move it. It takes pressure at the margin. And when institutional capital begins entering a structurally tight market, price moves faster than expected. Not because of hype, but because of math. And the structure of silver right now is already showing historic strength. Because February is closing green, that makes 10 consecutive green monthly candles. 10. That has never happened before in modern silver trading history. Not once. Even during the famous bull run of the late 1970s, when silver rose from $6 to $50, momentum built gradually, but sustained strength like this, 10 straight months, signals something deeper. It signals persistent accumulation, it signals continuous demand, it signals buyers stepping in repeatedly, even after corrections, even after volatility, even after aggressive sell-offs. Because remember, silver was crashed earlier, driven sharply lower, and yet it still recovered enough to close green. That tells you something critical. Forced selling was not strong enough to overwhelm physical demand. Buyers absorbed it. Every drop found demand. Every correction found support. And when a market refuses to stay down, it reveals the presence of stronger hands beneath the surface. Hands that are not trading for days or weeks, but for years. And here's what makes the situation even more explosive. Retail investors are barely here. Historically, retail participation is what defines the final phase of commodity bull markets. It's what happened in the 1970s. It's what happened in countless commodity cycles. Early stages are driven by institutions. Middle stages are driven by industrial demand. Final stages are driven by public participation. Right now, retail ETF holdings have actually declined over the past year, even as price climbed. Think about that. Silver has been rising. Without broad retail participation, without mainstream excitement, without widespread speculation, that means the market is still relatively thin, still structurally fragile, still capable of moving dramatically when new demand arrives. Because when retail demand eventually flips from neutral to aggressive accumulation, supply does not magically increase to meet it. It has to be repriced higher. That's how bull markets accelerate. Not gradually, but suddenly. Because there simply isn't enough metal available at previous prices. And while financial forces reshape the market, geopolitical forces are adding fuel at the same time. Recently, the United States authorized the departure of non-emergency personnel and family members from Israel. Evacuation language began appearing in official communications. Bomb shelters reopened. Military positioning intensified. And financial markets reacted immediately, within just 3 hours. Approximately $650 billion was added to the combined market value of gold and silver. $650 billion? Not retail money, not small investors. Institutional capital. Because when geopolitical uncertainty rises, investors seek assets outside the financial system. Assets that cannot be frozen. Assets that cannot be digitally erased. Assets that exist physically. Silver and gold have filled that role for thousands of years, not because of tradition, but because of independence. They exist outside counterparty risk, outside political promises, outside institutional guarantees. And that independence becomes more valuable during uncertainty. Meanwhile, the structural pressure inside the vault system continues. Registered COMEX silver sits around 86 million ounces. At the same time, open interest obligations remain massive. That creates a coverage ratio near 0.6, meaning only 60% of potential delivery demand can be satisfied with registered supply. That does not mean failure is guaranteed, but it does mean stress increases as demand rises. Because every ounce removed reduces flexibility. Every ounce delivered reduces buffer, and when buffers shrink, markets become more sensitive, more reactive, more volatile. This is why both Eastern and Western vaults are seeing withdrawals. Metal is moving toward ownership, toward end users, toward long-term holders, away from passive storage. But it's critical to remain honest about the risks, because volatility cuts both ways. Exchanges can intervene. They have before. Geopolitical tensions can de-escalate. Demand can temporarily slow. Vault inventories can be replenished. Retail investors can sell instead of buy. These outcomes remain possible. Markets are not guaranteed. They are probabilistic, and discipline matters more than emotion. Because structural trends unfold over time, not in straight lines, not without setbacks, not without corrections. Even the strongest bull markets experience violent pullbacks, moments designed to test conviction, moments designed to shake out weak hands, moments designed to reset positioning. But step back and look at the full convergence. Silver breaking $92, Shanghai paying $12 above Western spot. Vault inventories declining across continents, India preparing to decouple from Western pricing, institutional capital gaining access to metals, 10 consecutive green monthly closes, retail participation still minimal, hundreds of billions flowing into precious metals during geopolitical stress. These are not isolated events. They are connected signals, pieces of the same structural shift. A shift driven by physical demand, monetary uncertainty, institutional positioning, and global realignment of price discovery. The timeline remains uncertain, volatility remains inevitable, but the direction of structural pressure is becoming harder to ignore. The data is public, the signals are visible, and the participants who understand the structure are already positioning for what comes next.